Are you tired of losing trades because of impulsive decisions? What if one simple habit, waiting for a candlestick to close, could transform the way you trade? In this video, I'll show you how to use candlestick closures to validate your trades, the mistake that turned my winning trade into a loss, and how you can avoid it. My exclusive fake closure candle strategy to outsmart smart money traps. Before we dive into why waiting for candlestick closures is essential, let's first break down what a candlestick actually tells us. Each candlestick represents price movement within a specific time frame, whether it's 1 minute, 1 hour, or 1 day. For a bullish candle, price opens at the bottom of the body. The low of the candle shows how far price moved down before buyers stepped in. The high shows how far price pushed up before sellers started to take over. The candle closes at the top of the body, confirming buyers were stronger during this time frame. For a bearish candle, it's the opposite. Price opens at the top of the body. The high shows how far buyers tried to push before sellers dominated. The low shows the furthest sellers pushed before buyers stepped in. The close is at the bottom of the body, confirming sellers had the upper hand. Now, why does this matter? Because until a candlestick closes, all of this movement is unconfirmed. Let me show you what I mean. Look at this example. The market is trending upwards and hits this level of resistance, then reverses. It pulls back, hits the same level again, and shows signs of rejection. Right now, the candle hasn't closed yet, but we can see what looks like a clear rejection, potentially signaling a reversal. Now, if you jump in at this point without waiting for the candle to close, you're basing your trade on incomplete information. Here's what happens next. The market closes bullish even though it initially showed signs of rejection. That rejection was only temporary, and after the close, the market revealed its true direction. It broke strongly above the resistance, confirming a trend continuation instead of a reversal. Finally, by entering too early, you would have been trapped in a false signal. This is why waiting for the candle to close is so important. It gives you the full story and prevents costly mistakes. Let me share an experience from my early days of trading, one that taught me a lesson I've carried with me throughout my long journey in the markets. I remember analyzing a chart where I had identified a clear supply zone. The price had just reached the zone and it formed a perfect pin bar signal. At the time, I was confident this was a strong setup. I placed a sell order right after the pin bar closed, set my stop loss just above the supply zone, and used a Fibonacci extension to determine my target. My target was at the 0.68 Fibonacci level, which is often considered a golden level. It was a swing trade on the daily time frame, and for the first and second days the market was calm. But on the third day, I started checking my screen periodically. In the morning, I saw the candle forming in my favor, moving away from my supply zone and reinforcing my analysis. But later in the day, the market started to push up against me, and the candle began inching closer to my stop loss. Fear kicked in, and I thought to myself, this is going to hit my stop loss. I should close the trade now and minimize my losses. Acting on that fear, I panicked and closed the trade before the candle even finished forming. But here's the kicker. The candle hadn't closed yet. When it finally did, it turned bearish, confirming my original analysis. At that moment, I was so frustrated that I made an impulsive decision and missed out on this trade entirely. Days later, the market continued in my favor and eventually hit my profit target. But it was too late. I was no longer in the trade and the opportunity was gone. By acting out of fear and closing the trade prematurely, I turned what would have been a winning trade into a losing one. That moment was a wake-up call for me, a lesson in the importance of waiting for candlestick closures to see the full picture before making decisions. Now, let me show you how smart money uses your impatience and impulsive trading decisions to trap you. This strategy is called the fake closure candle strategy, and it consists of 4 key candlestick formations. The first candle in this setup is the range candle. This candle sets the boundaries for the market during the day. The high of this candle marks resistance, the level where price struggles to go higher. The low of this candle marks support, the level where price struggles to go lower. These levels are critical because they define the range for the setup. Next, we have the inside candle, which forms completely within the range of the first candle. This candle shows consolidation or a pause in the market. It's a sign that the market is undecided and building energy for the next move. At this point, we know the market is in a range, but we're waiting for the next candles to give us more information. Here's where things get interesting. The third candle, called the fakey candle, plays a key role in this setup. During its formation, the fakey candle breaks out of the range. If it breaks below the range candle's low, it looks like a bearish breakout. If it breaks above the range candle's high, it looks like a bullish breakout. This is where many traders get trapped. They see the breakout happening mid-candle and jump into the trade thinking they're catching the move early. But here's the catch. When the candle closes, it ends up back inside the range. This is what we call a closure trap. The market gives the illusion of a breakout, but the candle's closure tells a completely different story. The fourth candle is all about confirmation. For a bullish setup, the next candle must close above the range candle's high. For a bearish setup, the next candle must close below the range candle's low. This confirmation is the final piece of the puzzle, telling us whether the market is ready to reverse or continue in the same direction. Without this step, the setup is incomplete. This strategy works so well because it takes advantage of the common mistake traders make, entering too soon during the formation of a candle. When traders see a breakout mid-candle, they rush to enter the market expecting the move to continue. But when the candle closes, it reverses and traps them in a bad position. This is why waiting for the candle to close is so important. It saves you from getting caught in these false breakouts or closure traps. Now, let me share an important variation of this setup that can make it even more reliable. Multiple inside candles. Sometimes, instead of just one inside candle, you'll see several small candles forming within the range of the first candle. These additional inside candles indicate that the market is in a prolonged consolidation phase. Why does this matter? Prolonged consolidation builds energy in the market. The longer the market stays within the range, the stronger the eventual move is likely to be. This means that when the fakey candle forms, it's even more meaningful because it follows a period of indecision. Think of it like a spring being compressed. The more it's squeezed, the bigger the release when it finally breaks. In this case, the fake out and confirmation that follow are even more reliable because they're backed by stronger market pressure. So, if you spot multiple inside candles in a fake closure setup, it's a sign that the setup is gaining strength. Always wait for the confirmation candle to validate the direction, and you'll have a higher probability trade on your hands. Alright, let's walk through some real chart examples to see how the fake closure candle strategy works in live markets. Here, we're looking at the Solana daily chart. First, we have the range candle. This defines the market's high and low for the day. We mark the high as resistance and the low as support, creating the range. Next, we see the first inside candle, then a second, and finally a third inside candle. All three candles are completely within the range of the mother candle, indicating consolidation. Now, here's where things get interesting. This candle forms and breaks below the range during its formation. To many traders, this looks like a clear bearish breakout and they enter short trades immediately. But here's the twist. When the candle closes, it moves back inside the range. This is a closure trap, showing that the breakout was false. Does that mean we take action right away? No. We still need a confirmation candle. The next candle breaks above the range, confirming the closure trap. At this point, the market is likely to move higher for the next 2 to 3 days. As you can see, the market moved up strongly because the fake-out candle also swept liquidity below the support level, trapping sellers. This liquidity sweep creates the momentum for the strong upward move. Now, let's take a look at another setup that formed just a few days earlier. Here's the range candle. Again, we draw the high as resistance and the low as support to define the range. Then, we have the first inside candle and a second one. These candles show that the market is consolidating. Next comes the fake closure candle, which breaks above the range during its formation. Traders who enter long here think they're riding a breakout, but when the candle closes, it falls back inside the range, creating another closure trap. Now, do we act on this immediately? No, we wait for confirmation. The next candle breaks below the range, confirming the closure trap. Once confirmed, the market moves lower 2 days later. Without this confirmation candle, we wouldn't consider the setup valid. Let's check out one more setup to help you spot the difference between valid and invalid setups. Here's the range candle, and we draw the range as usual. Next, we see an inside bar, followed by a closure trap candle, and finally a confirmation candle. At first glance, this setup might seem perfect, but here's the problem. The inside candle broke out of the range. For a setup to be valid, the inside candle must stay completely within the range of the first candle. This means both the body and the wicks must remain inside the range. If they don't, the setup is invalid. I'm showing you this example to help you recognize when to skip a trade and avoid setups that don't meet the criteria. Now, let's look at a valid setup. Here's the range candle, followed by an inside candle that stays entirely inside the range. Next comes the closure trap candle, which breaks above the range during its formation, luring traders into impulsive long positions, but by the time the candle closes, it's back inside the range, revealing the trap. Finally, the confirmation candle breaks below the low of the range, validating the setup. And as you can see, the market moves downward after this confirmation. This strategy might not catch massive moves every single time, but it's extremely useful for predicting the market's direction over the next 2 to 3 days. Once you see the confirmation candle, you know where the market is likely headed in the short term. You can use this information to refine your day trading strategy and approach the market with more confidence. So now you've seen how the fake closure candle strategy can help you predict market direction and avoid impulsive mistakes. Take this knowledge, practice it on your charts, and see how waiting for confirmations can transform your trading. If you found this video helpful, hit the like button, subscribe, and let me know in the comments what you think of this strategy. Thanks for watching, and I'll see you in the next video.